Well, welcome. This is the May webinar for Principal Wealth. I'm Julina Ogilvie, Partner and Wealth Advisor, joined by our CEO, Bob Paolucci. The title this month is April Showers Bring May Flowers. And as we record this, I believe it is actually thundering outside my window. So, Bob, welcome.
Welcome to this rainy Friday in May.
I know this is a fun way to kick off the day. We have a agenda that we want to share with you. So let me pull that up really quick. And we are going to follow our cadence of discussing the markets, followed by the economy and policy, and then summarizing and everything else bucket. If there's anything you want to share, Bob, before we get going.
I mean, that sounds wonderful. There's a lot to talk about, and there's some fun data to extrapolate from all of this. And let's have a blast with this one.
And hopefully, if people can sense from the flowers on our lovely slide that we are optimistic, if I can summarize that as we get into this.
I mean, Mother's Day maybe was the theme, or the April showers bring May flowers. But sure, optimism, we're full of it.
Yes. And so I think to quickly kick this off, we have to address where we are with the markets, which I really think is surprising everyone when we have our discussions at our reviews.
Yeah, where are we? So this is a few days old here, but year to date, we have the S&P 500 down a slight 3% for the year. Nasdaq is down a little bit more because it's the home of the Magnificent Seven, which are down a little bit more than the market, so it's down 6. The Dow's down 2 to 3. Again, shocking because just about 3 weeks ago, the market was down peak to trough about 20%. We invested in it right at the bottom, and now it's not. So, it just tells you you have to keep your cool
Yes.
and you have to buy in the bad news. And if you do, things work out quite well over short and long periods of time.
Yes.
We'll get into that more, but here's a good snapshot of various indices, how they're doing, week, quarter to date, year to date, 1 year, 3 year cumulative, so on and so forth. So you see it there for yourself. We've been telling you about it, but there's the evidence of it.
And diversification is working because the bond market is up during this time.
Yeah, bond market's doing well. Foreign stocks, for at least a short period of time, have done okay. I'm not going to be fooled into thinking that we should invest heavily there because I think there's some weakness there. But at least in a short period of time, they've held up quite well. But yeah, look, our clients have diversified portfolios. They're doing better than the market is doing, and I think they know that.
Yeah.
There are outliers if clients have significant exposure to a handful of stocks that aren't doing well. Well, that will skew things, but all in all, our clients are doing very well. And I think they're all shocked that they're doing so well relative to what they're hearing and seeing. How about that?
Abs Absolutely. And I think, with all of this emotion, you can see some of this volatility. You addressed April, if you can maybe review what transpired.
Yeah, so the month of April, April showers, really that applied for the first half of April. Here's one day, going back to April 7th, specifically at about 9:50 a.m., 20 minutes after the market opened. The market bottomed, the S&P 500 bottomed at 48.35. And again, peak to trough at that point, it was down 21% for the year. Now, if you're a client listening, and you saw this happen. We bought that bottom. We had about 4 or 5 minutes to take advantage of that bottom, but we had prepped for the prior 3 days for that bottom, and we executed for you. Again, within that 4 minute period of time, I should tell you that we did some analysis. I believe we were 12% of all buying during that period of time in the market. Little old us. We were propping that market up. You
Yes.
know what? I could argue that we helped put the line in the sand in the market. If it weren't for us, the market would have gone lower. How about that? I mean, probably not much lower, but a little bit lower. So we took advantage of it. But
Yes.
amazing how from that bottom on April 7th at about 9:50 to 9:55 a.m., the S&P 500 is now greater than 17% higher from there.
Right.
Shocking how things change.
It's amazing how it changes so quickly. And can we also give a shout out to the team, because for us to execute this, it literally took a team, and it took a team coming in over the weekend. There was a lot of effort that went behind this.
Yeah, there was every couple of hour internal blog that we were writing about what was going on. We were all on the same page and we executed. The best thing for us as a business and what I'm so proud of is our ability to execute. Doesn't matter that it was tax time. I mean, it did matter, but we executed on that too. Doesn't matter that we were meeting with clients and talking to clients and doing our normal stuff. Quietly, we went into SWAT mode and we executed stealthily, consistently. We did what we had to do and we stepped out. And you look at it now, it really is going to make a big difference for our clients. So kudos to the team for making it all happen.
Absolutely. And one of the things I love about this conversation that we're going to talk about right now is in the short term, clients may not really understand, but let's talk about the opportunity that we think we have created. And we have to start first with the volatility.
Yeah, and one of the signals for us, and one of the institutional signals for um, changing asset classes, usually not in a good way. To us, we use this indicator in a good way, mind you, is the volatility index. So when the volatility index spikes, I always say this is like, the common sense indicator. This is the indicator saying, hey, volatility's high. Well, it's like, no kidding. I don't need the indicator. I can just look at all the other stuff and I see that volatility's high. However, when you have high volatility, what you should do is invest money. Very simple. You just stop talking.
It sounds so easy, but it
It's
means we're
not so
super
easy. Yeah,
emotional.
I know, because the setting when you have this high volatility is like the world's ending. You got people talking about changing citizenship. You've got political biases coming in. You've got are we going to war with China? What's going on?
Right.
Yeah, easier said than done. But that's what we're here for. This is what we do. So we had a very rare VIX level, volatility index level, that hit 60. And that was one of the things that we were waiting for, to invest a large swath of money, and we got it, and then we did. And if you look over time at prior elevated levels, you typically always want to invest money around a volatility index that's greater than 30. Rarely do you get something that's greater than 40. Rarely do you see it go greater than 50, and it is quite rare to see a reading above 60. And at all those levels, future returns are great. Um, when the volatility index is down near 10 or 11, it's probably not a great thing. It means, you know, it means volatility is about to rise, and
Absolutely.
you
And really, there's only been two other notable periods in the last 20 years that the VIX has elevated to 60. It was the financial crisis and it was the pandemic.
yeah, and more specifically the financial crisis, but more so the end of it,
Yes.
right? The end of it, where there was just everyone was exhausted,
Hmm.
and the market turned.
Absolutely.
And then, yeah, really the pandemic was 5 days in the month of March.
Yeah.
And investing wise, we know how that turned out quite well. And we just had another one on April 7th. It existed for a couple of seconds,
Yeah.
but we checked that box, we got it, and we invested money. So again, one of our probably in a bad market scenario, one of our like 15 indicators. This does have some weight though, and it made us feel great about investing money.
And I think the proof of what we're suggesting is on the following slide, because when you look at elevated periods of the VIX in the past, you can see the returns of the market, not only 1 year out, but 2 years and 3 years and 4 years and 5 years. And the differential only gets stronger.
Yeah, yeah, interesting chart. So when you have a 4 day period measured over a 4 day span of volatility spike of greater than 75%, I mean the 1 year, 2 year, 3 year, 4 year, 5 year future returns tend to be amazing.
Mhm.
Um, this was the third largest volatility spike over a 4 day span in history. And we think future returns will look very similar to the prior top two, three, four times it has happened. And that means investors will be very happy with the outcome over time.
And what I love about this slide, Bob, is the trades that we placed in April for our clients. It really wasn't just for the short term. This is really setting the stage for
Oh
longer
yeah, I
term
mean
performance.
it was a combination of great time to rebalance portfolios to buy some equities that were depressed. Number one, number two, we did some tactical positioning using cash, selling some fixed income, really leaning into the sale that was upon us. But you're right, this is going to pay major dividends both actual dividends and reward over a long period of time. So we're very excited.
Absolutely. And I think another way to look at volatility is to look at the swings of the S&P, let's call it.
Yeah, I mean, volatility is. I mean, you have to observe it,
Yeah.
right? It happens, but if you're not watching, then you don't know what's going on. So the day-to-day move in the market, the intraday move, where it opens, where it closes, where it went, right?
Yeah.
It's wild. And you look at this chart here, and this illustrates every day the price movement going back the past 10 years. This is every single day. And you'll see the percentage change sort of at the middle to the top is positive, and the middle bottom half is negative. And you can see there's just a lot of movement. There's a lot of movement. You have to look away. Do not watch the sausage being made. It will
Right.
drive you crazy. It'll make you very emotional. It'll make you question every investment. Businesses don't truly change value that often. A small subset of their shares does trade every day,
Hmm.
and they're liquid, so it does have to move because there are institutions and people and companies themselves that are in and out of the markets, but that is not a reflection of the true intrinsic value of a company.
Yes.
So if you don't understand that, you really should just stop paying attention, right? You're going to waste a lot of time if you don't understand that.
Right.
Tracking your investments and saying, wow, it's green or it's red, or this is going to make it go green or this is going to make it go red. You know what? Go work on something else. Go work on your health. Go paint or ride a bike or pick up photography or something like that. Do something better with your time. If
It's
you're
so
stuck,
difficult to do though, because
it is difficult to do.
constantly in front of us, right?
And
We
the
all have
game,
our
yeah,
outlets.
and the gamification of investing
Yes.
has made it a playful sport almost, right? An
Mhm.
activity, a hobby. But if you don't know this stuff, your hobby could turn into danger, and your emotions could get the best of you. And if you act on those emotions, your returns will stink. Hopefully, that's why you have us here to
Yes.
tell you that the world is not ending. And if it is, don't worry, we'll plan for it. You have to measure less frequently. You
Correct.
have to measure less frequently because perfect observation would be if you looked at your account in March and you looked at your account now, nothing happened.
Right.
And for some of you, it's higher. For some of you, it's about the same. But what a month April was,
Hmm.
right? The conversations that people were having in their head and with us in April, uh, none of which clients were proactively reaching out to us. We were just calling people to say, hey, are you okay? Like, no, we trust you. It's like, I know, but I figured, all right, whatever.
Other response was, no, are you okay?
Yeah, you okay? All right, we're fine. We're making sure you're alive.
Yeah.
But I know a lot of investors were thinking all sorts of stuff
Right.
in April, which is why we wanted to reach out to say, look, it's not over. We're fine. We're taking advantage of this, so on and so forth. But are you still having those same conversations now in your head? Are you still having that? Do you still have the same outlook that you had 3 weeks ago? No. We've turned the corner a little bit, and it's amazing how emotions can take over. Here is now the view. Go back one slide,
Hmm.
show the daily movement of the market. It's wild, right? Now, let's look at just measuring once a year over
Right.
that same period of time. Yeah, the market goes up,
Exactly. So when
right?
we're suggesting not to look at your statements on a daily basis, there is some validity behind that.
Yeah, I mean, if you look once a year, this is what it looks like.
Yeah. Yeah.
2016 to 2017, up. 2017 to 2018, up. 2018 to 2019, up. 2019 to 2020, up. But there was I don't know, the world shut down during that period. Remember, during that period, the emotions, the health risk, the financial risk, the social risk that was happening. Oh my God. Market was higher.
Yes.
2021 higher. 2022 lower, bear market, but it wasn't as bad if you looked January to January. If
Correct.
you looked peak to trough, yeah, you were probably nervous, but January to January, just give it some time, didn't look that bad.
Yes.
2023 up, 2024 up.
The probability is always towards the higher end on an annual basis. And
Measure less frequently.
yes. So let's talk about the emotions and maybe give some reasons for optimism from here.
Yeah. So, look, we love the behavior of investors. We love behavioral finance. and we don't like the um, nanosecond talking points on TV and financial media and the newspapers, there isn't really thorough thought or thorough analysis or deep projections or fair balancing of what's likely or what's probable. Everyone just talks about what's possible. Well, anything's possible, right?
Hmm.
What's the motivation of the person talking about what's possible? Then it'll be skewed a certain way. How about we just talk about what's probable? And if we talk about what's probable, um,
There's a lot
we
that we
can
can
have
talk
a
about.
brief chat and then we won't talk for some time.
Mhm.
Right now, what's possible with tariffs? Anything. What's probable? Probably. I'm going to go on a limb here and say versus the current plan minus the UK, that seems to have been resolved. The current rates of tariffs will be lower than the current proposal.
Mhm.
Okay, that's good. Why? Well, because the market has these ridiculous high rates priced in. Yeah.
Yes.
What's likely, what's probable, is we'll settle on something lower. Probably that 10% that we talked about 2 months ago.
Hmm.
That seems to be where the UK landed. Hint, hint. What's possible with taxes? That we'll probably get an increase in the SALT deduction. We'll probably get a small corporate tax cut, and we'll probably see accelerated depreciation. Well, that sounds actually net positive for the economy and for business and
Correct.
generally for most people. Yeah,
Yes.
that's right. What about regulation? Oh, there'll be
No
less.
one's talking about regulation.
Yeah, there'll be less of it.
Hmm.
Okay. What about the Fed? We're probably looking at lower rates according to what they're saying.
Yes.
And we're looking at the end of quantitative tightening, which, is stimulative. Okay. What about earnings? Well, they'll likely be higher than expected because that's usually the way it works. Um, we have a advantage here because expectation of the specialist for corporate earnings has now been lowered. So CEOs of companies said, well, if you're going to expect less, we're going to tell you that we might do less. And
Hmm.
then when we actually report them, we'll report better than lowered expected
Yes.
expectations. Therefore, our stock will go even higher. Yeah.
Which is
So
a common occurrence.
it happens all the time.
Yes.
What about employment? Oh,
Mhm.
anything's possible, but I think we'll have slightly less employment, therefore slightly higher unemployment. Yeah, right. And that's what the Fed thinks as well. Real estate, anything can happen, but I think mortgage rates will continue to come down. I think there'll be more housing supply, and I think we'll have slightly softer prices.
Hmm.
Okay, more supply, softer prices, right? Supply demand. How about inflation? Well, inflation will continue to decline. You just have to measure over a proper period of time. Month to month stinks. You have to do it in rolling 6 month periods, rolling 9 month periods.
Yeah.
Inflation's been in the twos now for uh, we're going on 9 months.
Yes.
We're about to hit a year within the next quarter. So, at what point do you say we're on target with inflation in the twos? And if we have any inflation from tariffs, which has not registered yet, mind you,
Hmm.
what's it going to go from low twos to high twos? You're still in the twos.
Yeah.
So, you got to stop the insanity a little bit. So, again, don't confuse possible with probable. And I think in a period of heightened emotions, the probabilities really don't change. And you're fooled into thinking that the possibilities do change.
Yes.
They usually don't. The probabilities rarely change.
And let's take it one step further and talk about there's a list here. There's a laundry list of 10 items of what can actually go right. And some of it
Yeah.
we've addressed and some of it we haven't yet.
Yeah. We had 40 items, but let's boil it down to top 10. And again, we're not, look, if you know me, I'm not the biggest optimist in the world. But ultimately, what can go right? Yeah, seeing that no one's talking about it, unemployment stays low. Yeah, it stays in the fours,
Mhm.
right? Which is near full employment. So anything less than, if you measure over a long period of time, anything less than 5% unemployment is full employment, right? The Fed's talking about, hey, if we go from 4.2 to 4.4, oh, we're cutting rates. It's like, oh, okay, great. We're almost there. Long-term interest rates decline. Yeah, it's actually happening.
Mhm.
Fed cuts expected. Short-term rates decline. Uh, yeah, this is what they're saying.
Right.
And it's also what we're saying. It's very likely to happen. Inflation continues to decline. Uh, right.
Yeah.
Energy prices are much lower, which feels like a tax cut. That's fact. Earnings continue to rise. that tends to happen more often than not. No recession. Yeah, the first quarter GDP number, if you look through it, that's not a recessionary quarter. That'll be revised higher, probably in the third quarter of this year. I
And we're going to show that.
mark my words on that one.
Yep.
Banks remain stable and have more liquidity. That's a very good thing. Buybacks continue to climb. That's a fact. And valuations are lower. That's a fact. So that's
That's
everything in the capital markets and the economy.
I would also suggest that there should be a number 11, which is the abundance of cash. And we talk about
Abundance
this
of
all the
cash,
time.
tons of liquidity out there. So the trillions and trillions of dollars held by institutions and individuals in money market funds, short-term deposits, it's amazing how much liquidity there is.
This is not
You,
corporations.
yeah, you can't have tough times with this level of cash. It's I don't want to say it's impossible, but the probability is tough times are more in our head than they are in our wallet.
Absolutely.
Yeah.
And let's also talk about one of the drivers of long-term growth, which is earnings.
Corporate earnings, which have been released now April and May for Q1. We have 75% of companies above their target, 5% matching their target, and only 19% below, which is right on par.
Mhm.
So no blip in earnings.
And,
So
and, and by
if
the
there's going
way,
to be a decrease, it's going to be out quarters. But I think there'll also be an increase. So I think the offset is going to be net positive over time. And we'll see that as time passes. But any of those forecasters saying that there's going to be a huge decrease in earnings, yeah, I don't know. I don't know.
yeah.
These businesses know how to run businesses.
And in looking at these businesses, a couple of other items that we always keep an eye on. One is buybacks.
Um, Julina, one would say if you're a business and you think you're going to miss your earnings or you're struggling to acquire cash, you would not be buying back your stock.
Mhm.
Right. Here is a chart of expected buybacks, and we just reached a new all-time high.
That is a massive surge.
Yeah. So companies said, yeah, we're going to buy back a ton of our stock.
Yeah.
And that is happening.
And not only are we seeing the buybacks, but we're also seeing dividends continue to grow.
Julina, if we're running a business and we're paying a dividend, if times get tough, we will either not increase the dividend or not pay the dividend. The increases of dividends continue.
Yes.
So that might be a pretty good sign.
Yes,
Yes.
absolutely.
Okay.
And so let's now transition to economy and policy. And I am, I don't know how to pronounce this. What is a TIDS optimist?
Well, Julina,
I don't know where you got this.
according to the Google machine, a Tidsoptimist is Swedish for time optimist, a person who habitually underestimates the time needed to complete tasks, leading to frequent lateness. They are often optimistic about having more time available than they do, causing them to arrive late or miss deadlines. The Fed is a Tids optimist because they have their projections, their targets for the end of the year, right?
Mhm.
Where GDP should be, unemployment rate should be, PC inflation, core inflation, and Fed funds rate. And well, wouldn't you know that all the indicators that they have, we're projecting to be on the underside of them. So therefore, you put these numbers out and you're data dependent. So if the numbers are lower than your forecast, that enables you to cut. So right now, these indicators, the current reading, say the Fed should be cutting rates.
Correct.
So that's why I'm calling them a TIDS optimist, because they just keep waiting. It's like waiting for Godot. What are they waiting for?
Yeah.
Right? It's at some point. Let's go. It's time to cut rates. The rate of inflation is in the low twos. Short-term interest rates is in the mid fours.
Yes.
That should match.
Yeah.
So rates are too high, probably by about 200 basis points. Why don't we start with a quarter? And why don't we slowly and subtly move rates back into the target zone? This way, in the future, the capital markets, big institutional investors don't lose faith in the Fed, and you just slowly move rates back to where they should. but no, the Fed likes to get it wrong and then have to do emergency things. Now, keep in mind, this is the same Fed that in 2022 and 2021 said there was no inflation. And then they increased rates by an insane amount in a very short period of time, all while saying we don't see any inflation.
And I think I noticed that you changed the title of the slide. We're recording this on the 9th of May. This is the week that the Fed met and did not cut rates. And I noticed that you changed the slide maybe following that meeting.
Maybe, maybe not.
Okay.
Good pickup.
Yeah.
Uh, but yeah, so like, look, at the end of the day, I get it. The Fed really should be slowly cutting rates here. And if they don't do it in June, I think the expectation now is they're going to do it in June. They might have to do more than a quarter towards the end of the year. So let's just get moving.
The
Let's just
pendulum always has to swing to the extreme, doesn't it?
Yeah, and it's not for us or the capital markets, but at the end of the day, there's so many lending rates tied to short and long-term rates.
Sure.
Let's get lower mortgage rates. Car loans are way too expensive right now, used and new.
Yeah.
Let's get the show on the road here.
Let's address inflation because it's certainly correlated to this conversation.
Absolutely. I can't seem to find it. Where is inflation?
Yeah.
So I don't see it on this chart. So, anyways, the bond market, the smart money, sort of prices in short and long term expectations for inflation. So on the top left hand side, there are 2-year, 5-year, 10-year, 30-year break evens, right? So it's really the smart money betting, the bond market betting
Can't
on,
ignore the bond market in
yeah,
this.
exactly, the path of inflation, and the path
Yeah.
is lower. The money supply on the top right hand side, which is not directly, but is very highly correlated with inflation.
Yeah.
Uh, Historical growth of money supply should be somewhere between 5 and 6%. Over the past year, it was 4%. So we had underwhelming money supply growth, which means we will very likely see even lower inflation.
And
Sh-
Bob, if I can point out, some of the most negative economists during this environment were honing in on the money supply, suggesting that this would spike.
yes, and now they changed their tune because that reading was below average.
Correct.
Yep.
Okay.
So money supply growth is lackluster. Therefore, the growth of inflation will be lackluster, but that's a positive thing. Shelter inflation measured live versus measured in the government data. There's about a 2.5% gap, bottom left hand side, 1.47 live versus 4 stale. And then, one little indicator that we like is home sold by type of financing, cash. Everyone's heard about, I want to buy this house cash. If you're our clients, you can afford to do that. But most home buyers across the country do not do that. The number of transactions closed with cash financing is declining rapidly.
Hmm.
Good, because that means prices will soften. That means inventory is probably rising. And, all that means these data points within the inflation calculation should continue to soften.
Correct.
Yep.
And another way to look at inflation, which I love, is looking at different baskets. I think we as consumers sometimes, when we fear inflation, we kind of hone in on one particular area. Like for example, I hone in on eggs because my family eats a ridiculous amount of eggs.
Well, Jelena, over the past 60 days, must be a happy camper because the price of eggs is down 58.51%.
Yay.
It's so funny how we pay attention to price increases, but we pay no attention to price decreases, at least when it comes to expenses,
Yes.
right?
Yes.
So this was just a random walk that we had, me, you, and Kyle in our office. We said, hey, pull up a list of commodities and just give me a 60-day view. Let's see if we can predict the path of inflation, right? Because a basket of commodities, let's pull up all the big ones.
Hmm.
Let's see the price change of these commodities over the past 60 days. None of them are positive. So we will begin with natural gas is down 5% over the past 60 days. Gasoline is down 9. Brent and WTI, so oil, is down 17. Wheat is down 5. Corn is down 3. Aluminum is down 9. Steel is down 6. Heating oil is down 15. And eggs are down 58%. So
Hmm.
I just wonder where all this inflation is going to come from if input costs and commodity prices are negative. Puzzling, but I'm sure we'll see. How about the next slide?
Also, a very interesting slide because a lot of individuals and investors over the last few months that were worried about the market volatility, one of the questions that always arises is, well, should I be investing in commodities? Should I be investing in gold? And I think it's just an interesting dynamic to see what's transpired.
Yeah, I mean, the price of gold is off of its all-time high. I have a hunch that gold will probably come down by another 25 to 30%.
Yes.
You really have to understand the gold market and who the big buyers are. And when you understand that those big buyers are temporary buyers, they're infrequent buyers. I'm struggling to see where the support for the price of gold is going to come from
Hmm.
over the next couple of quarters.
I think that's a great point for some. Yeah, thank you. And so our TIDS optimists are hesitating to cut rates, but yet the rest of the world seems to be doing so.
Well, nowadays versus maybe 30 years ago, the developed nations and some of the emerging nations, our economies are somewhat linked,
Mhm.
and our monetary policy is somewhat linked, right?
Yes.
Except for when you're the United States versus really the rest of the world, you stopped cutting rates. The rest of the world is cutting rates. The rest of the world is seeing lower inflation. So how are we going to see inflation? The rest of the world is cutting rates, seeing lower inflation. That tells me we are going to see, again, don't measure by month, measure in, I don't know, quarters. We're going to see projected lower inflation quarter over quarter, year over year, at least for a little while longer. And that means we should have lower rates. Our short term rates should be somewhat near our inflation rate. And
Yes.
right now it is not. And I believe the trend is it will get much closer.
Hmm.
And I'd like to proactively get there, but one way or another, we're going to get there.
Yeah. This will be
So,
really interesting to watch for the remainder of the year. And let's talk about the economy. We alluded before that we're not in a recession. We don't believe we're going into a recession. So this does a great job of showing the makeup of our economy.
yeah. So, yes. So there's, when you look at the economic data, right, there's consumption. You can see it's 70%.
Mhm.
Approximately, you have business fixed investment, you have government spending, you have residential activity, net exports, change of private inventories, right? So the first quarter GDP number came out really a rounding error to zero, but it was factually negative 0.3. So you say, well, wait a second. Don't you need a negative quarter of GDP to start it might be a recession process? Technically, yes. A good chunk of it is having two consecutive quarters of negative GDP growth. However, you do have to look into the report and understand that we had positive consumption, positive business fixed investment. We had a delay in some government spending. That's why it was barely negative. Uh,
Hmm.
did have positive residential activity. We had a change in private inventories, but we had this wild net exports negative number. What does that mean? That means that businesses bought a massive amount of stuff in the first quarter of the year. We imported so much stuff
Why, Bob?
in anticipation of tariffs and trade wars and all this stuff to buy stuff at fixed lower prices to be consumed in the coming quarter or two, bloated inventories potentially at now lower prices. And that just created this snafu in the GDP report.
Right.
So even the Fed looked through this and they talked about it this week in their meeting. They're like, yeah, well, this is a calculation, almost like an error in calculating.
It's
It
not a
shouldn't be this way.
sustainable number.
Yeah, exactly. This number, first quarter of this year, will be revised higher probably by the end of the year.
Hmm.
So the negative will be here until it's revised. But yeah, technically, we did have a blip, a slight negative quarterly GDP number. And when it happened, everyone capitulated and said, oh, we're going to have a recession. This is a recessionary number. Every headline was recession. And then about, I don't know, 45 seconds later, when they started to look into the data,
Hmm.
which you should really do before you open your mouth, they said, oh, we should stop talking about this because if it wasn't for that big, ramp up in
Right.
imports, we actually would have had a great first quarter of economic growth.
Yeah. I
When
mean,
you net it out.
you and I have joked as to how many economists and strategists that were very, very vocal about a recession have pivoted to this
Yes,
point.
you're exactly right. So those who were most negative about the economy looked at this data and became positive.
Yes.
And those who don't pay attention were like, "Oh boy, we're going into a recession." That's not what this report showed. You
Yeah.
just have to understand what you're looking at. So, anyways, we thought we would just cover it because it's just a confusing data point.
Absolutely. And I think one of the reasons that it can be so confusing is that we have this whole concept of soft data versus hard data.
Yeah, the soft data is measuring short-term emotions. The hard data is if short-term emotions turn into long-term
Mhm.
negative activity, which usually doesn't. I mean, even the field today versus 3 weeks ago has changed. I've got to think the soft data will improve from the prior reading.
Yes.
You just feel it. It's almost like common sense.
Right.
But if it doesn't, there is a lag. There's about a 2 to 3 month lag between soft data and actual hard data. The
Mhm.
economy feeling the pinch of negative emotions or pulling back or not doing this or not spending, so on and so forth. So there's a lag because the hard data does not reflect the sour emotions of people
Yes.
at all.
I like to call the soft data our wall of worry, which never, ever goes away.
Yeah, true. Yeah,
Constantly
it's
changing.
just what degree is
Uh-huh.
it? You're right.
Absolutely.
Yeah.
And it's hard not to have a conversation around the economy right now without bringing up housing.
Yeah, so we hinted at this, but here is a view of housing inventory and the year-to-date path versus prior years, going back, a handful of years. What
Mhm.
you can see here is the level of inventory January, February, March, April, so far year-to-date as measured, is higher than 24, higher than 23, higher than 22, higher than 21. That's a very good trend. So a lot more listings, relatively speaking. When we get back to trend, that'll probably be about 1 million listings. We're just under that right now, but
Yeah.
we are certainly getting there.
Yep. Let's transition to the end of the webinar with the everything else, where we have 3 points we wanted to highlight. And I think this is another great thing of what can go right over the longer term when you look at the sort of the demographic shift.
Yeah, looking at the amount of wealth and the amount of consumption and the ability to consume, it is really born out of the baby boomers, and a lot of it is actively being transitioned to Gen X, which Julina, that's me and you. Oh boy, we're Gen Xers.
Yeah.
But boomers have so much money and so much wealth and so much success that they've started handing it to Gen X and in some cases millennials. And Gen X, we're pretty responsible and successful ourselves too. So, you just have a couple of generations, couple of mighty generations of wealth and success and good activity and hopefully positive habits and all this fun stuff. We've never had this, right? So the global economy, this is new for the global economy, starting maybe 10, 15 years ago, post financial crisis, right?
Yes.
Everyone has sort of righted the ship to a degree. There is so much wealth and so much ability to consume and so much consuming. I just think tough times are going to be redefined,
Yes.
at least from a financial standpoint. There's so much cash on the sidelines. There's so much public and private investment. There's so much money out there that tough times need to be redefined. And I think tough times will end up being, paper cuts and scratches on elbows and, dropping a coffee and being upset at minimal things, at least financially. You can relate to the silent generation when they say, when I was your age, I walked 9 miles to school barefoot. Yeah, it's boomers and Gen Xers didn't have it as bad. Millennials won't have it as bad, and Gen Z won't have it as bad, and Generation Alpha won't have it as bad. Hopefully, right? Hopefully, positive saving habits, positive spending habits, generations of savings and investing, and not getting carried away with leverage and ridiculous spending and bad habits will just create a good path of wealth creation and
Yeah.
positivity, which could be sustained for a very, very, very long period of time. So,
I,
which is why you have so much success in these big and small businesses, right? If you run a good business, you'll be successful. If you run a bad business, nobody can help you. There's a lot of wealth out there. There's a lot of demand, and I don't see that going away in my lifetime.
no, one of the statistics on this slide that I think is so important is that our kids, in essence, over the next 10 years are going to have about 9 trillion in spending power, which
Oh,
is
that's ridiculous.
a scary number because there have
Ridiculous.
been endless books and white papers written on the power of these studies of the demographic shift. So,
Julina, we were trying to end this on a good note. Our
yeah,
kids spending $9 trillion. This is frightening. We got to get out of this slide.
it's
It's
scary.
scary.
Well, yeah, on a sadder note, right? This is the end of an era for us, for some of us that have idolized some of the more essential investors in our lifetime.
Yeah, so the Oracle of Omaha is calling it quits at the end of the year.
Oh,
So he will be no longer the CEO of Berkshire Hathaway. He will be joining the board. I think we all knew it was going to happen. I don't think he wanted to die in the role, which is, very wise thing to do, to hand it over to his succession plan that has been in place for, I'm thinking now it's been almost a decade. It's time, and they're going to do a very good job. They do run the day to day at that business, anyways. Keep in mind, Berkshire Hathaway, they don't do the normal quarterly conference calls about their earnings. They do it once a year. They have one shareholder meeting a year. They write one memo a year because that's what they do.
yes.
And I think more companies should do that, but they don't. So, you look at them quarter to quarter. Berkshire Hathaway, you look at, once a year.
Yeah.
So end of an era. It was a phenomenal era. And again, I think Berkshire Hathaway will continue to operate the exact same way it operated. I don't see any changes there.
Okay. Very interesting run.
Yeah.
And we always love to remind and suggest that volatility is normal, and we're going to continue to remind our clients this as we go through the year.
Look, unless you're in San Diego, whenever it's 72 degrees, no humidity with a slight breeze every day for a long period of time, you're either dreaming or you're in San Diego, or there's a tsunami about to hit. Volatility is normal. The price of your house is wildly volatile. You just don't price it every day. The quality of your relationships might be a lot more volatile than you think. You just don't price it every day. And markets, they do price every day, and you get to see it. And the media pushes out that information as if you have to do something about it. You don't have to do anything.
Mhm.
If you can ride the volatility wave, your reward for that is high compounded positive returns over a long period of time.
Mhm.
If you can't, the penalty is no return over every measurable period of time,
Yes.
right? So volatility is normal and we welcome it. We just talked in this same presentation about investing during the most volatile times. Yes, it is the most rewarding of times, right?
Yes.
So
This is when you can make your money.
this is when you make a lot of money. This is when you get a jump start, head start. Volatility is normal. Embrace it. And if you do, look, the way to embrace it, just don't look at it.
Mhm.
When you do, good things come.
Yes.
I think everybody listening generally knows that. We just want to reinforce that to you.
And not only should you embrace volatility, but maybe over the weekend you can embrace all the mothers out there and say Happy
Pick up
Mother's
the
Day.
phone and call your mother if you still have one. If you're lucky enough to still have one, call your grandmothers if you still have one. And if you're a mother or a grandmother and no one's calling you, pick up the phone and yell at your kids and grandkids, or your neighbor, whoever. Yell at somebody. I love this chart because it shows on the left all the great things mothers have done for us, and everything we've ever said in history of time. There's only this tiny little overlap, which is the amount of times we've said thank you to our mothers. So, on behalf of all of us at Principal Wealth, happy Mother's Day to all the moms listening and all the moms that I employ and everybody that I know. Happy Mother's Day. Thank you for everything. Without you, there is no us. Julina, happy Mother's Day to you.
Thank you.
And that's all I have for today.
Yeah, happy Mother's Day to everyone. And also, we want to thank our clients and our listeners. We always value the trust, and we always welcome questions and concerns. We're here, so please pick up the phone and call us if there's anything further that we can address for you. And Bob, as always, thank you for your time. We're looking forward to another webinar in June and more topics to come.
And better weather.
Yeah, better, yes, better weather.
See you next month.